Despite record headline numbers for Coeur, a bear case persists, focusing on the structural risks that could derail the company's momentum if commodity prices normalize or if operational execution falters. Structural cost concerns and AISC comparison. A significant weakness in the Coeur thesis is its historically higher cost structure compared to its peer group. Even with recent improvements, Coeur is often characterized as a higher-cost mid-tier producer. In Q4 2025, adjusted cash costs per ounce were $1,207 for gold and $17.29 for silver. While these costs support high margins at 2026 metal prices, they provide a smaller margin of safety compared to lower-cost producers if prices retreat.
The bear argument suggests that Coeur's high operating leverage is a double-edged sword. While it fuels explosive growth during price surges, it causes disproportionately large swings in cash flow during downturns. Jurisdictional risk and the Mexican regulatory pivot. Perhaps the most pressing risk factor for Coeur is its heavy exposure to Mexico, particularly in the current political climate. Mexico accounted for approximately 45% of Coeur's revenue in Q1 2025, and management expects roughly 80% of its $400 million to $500 million in 2026 cash taxes to be paid. The 2023 amendments to the Mexican mining law fundamentally transformed the regulatory framework. One of the most disruptive provisions was the mandate that pending applications for new concessions be dismissed without further processing. In early 2025, the Mexican Supreme Court upheld this mechanism, reinforcing state dominance and significantly diminishing the judicial protection available to private mining companies.
This regulatory environment creates multiple layers of risk for Palmarejo and Las Chispas. Permit expirations. At Las Chispas, the company is currently attempting to amend an operating permit scheduled to expire in November 2026. In a hostile regulatory environment, renewals are no longer guaranteed. Sovereignty-based policy. The shift toward competitive bidding for concessions means that Coeur can no longer rely on the first-come, first-served model to expand its land holdings around Palmarejo. Taxation and water rights. New regulations across the national water law and related environmental legislation could impose additional capital expenditures or operational restrictions. The areas surrounding Coeur's Mexican operations are also subject to drug cartel-related violence, extortion, and theft. SEC filings have noted that security concerns in communities near Palmarejo have previously impacted supply deliveries. Acts of civil protest intended to restrict access to mining property are a recurring risk, often occurring without warning and leading to significant direct costs. Integration and technical complexity risks. The scale of the new gold merger, while a strength, also introduces significant execution risk. Integrating a $20 billion entity requires harmonizing cultures, safety standards, and operational systems across multiple jurisdictions. Specific technical risks include block caving at New Afton. The ramp-up of the C-Zone is 79% complete as of late 2025, but any geotechnical issues in the cave construction could delay the expected production step-up for 2026. Heap leach recovery rates. Rochester's performance depends on maintaining the record placement rates achieved in 2025. Any decline in recovery percentages from the massive 10.2 million imperial tons placed in Q4 2025 would negatively impact 2026 guidance. Permitting in Canada and Alaska. While Canada and the U.S. are generally stable, they are not immune to permitting delays. Kensington in Alaska and the Rainy River underground main expansion both require ongoing regulatory compliance that can be slow and costly. Valuation. Coeur's stock price has shown massive volatility, with a weekly volatility of 11% compared to the broader market. The company's forward PS ratio of 8.4x is significantly higher than historical norms, and its PE of 29.7x suggests that the market is already pricing in a near-perfect execution of the 2026 guidance. The bull case: senior status, scale, and silver leverage. The bullish investment thesis for Coeur Mining in 2026 is anchored in the step change of its operational scale and the unhedged nature of its revenue stream during a period of structural supply deficits in the silver market. The new gold merger, a transformative catalyst.
The pending acquisition of New Gold Inc. is the primary driver of the 2026 bull case. This transaction is not merely an addition of assets, but a fundamental transformation of the company's identity into a senior producer. The merger integrates 7 North American operations, with the most significant additions being the Rainy River and New Afton mines in Canada. The pro forma combined company is expected to generate approximately $3.0 billion in EBITDA and $2.0 billion in free cash flow in 2026. This projection assumes a production profile of approximately 1.25 million gold equivalent ounces, including 20 million ounces of silver and 100 million pounds of copper. From a second-order insight perspective, the introduction of copper through the New Afton Block Cave mine provides Coeur with exposure to the green energy transition, a sector currently driving long-term industrial demand for silver as well. New Afton, located in British Columbia, is a flagship asset that successfully transitioned to its C-Zone production in 2025. The mine is established to deliver strong operating margins with life-of-mine total operating costs averaging less than $30 per ton. In 2025, New Afton met its guidance with 50 million pounds of copper and 63,536 ounces of gold. Rainy River, situated in Ontario, achieved the top end of its 2025 guidance, producing 290,236 ounces of gold. The asset generated a record $183 million of quarterly free cash flow in Q3 2025 alone. The combination of these two mines adds approximately 350,000 to 400,000 ounces of gold production to the Coeur portfolio, significantly stabilizing the company's cash flow profile in lower-risk Tier 1 jurisdictions. While the New Gold merger adds gold and copper scale, Coeur's internal silver core, driven by Rochester and Las Chispas, provides the primary engine for margin expansion. The Rochester expansion in Nevada reached record levels of ore crushing, 6.4 million tons, and placement, 9.3 million tons, in Q4 2025. This suggests the technical teething issues often associated with large-scale heap leach expansions have been largely mitigated. Las Chispas, acquired through the Silvercrest transaction, has proven to be an exceptionally accretive addition. In its first year of operation under Coeur, it generated $285.8 million in free cash flow. The high purity and low cost of Las Chispas's silver and gold ounces are critical to balancing the company's overall all-in sustaining cost. A defining feature of Coeur's strategy is its commitment to remaining unhedged. In 2025, the company captured average realized gold prices of $3,818 per ounce and silver prices of $54.30 per ounce in Q4, representing substantial quarter-over-quarter growth. With spot silver having tested levels above $120 per ounce in early 2026 before stabilizing near $77, Coeur's revenue model is highly sensitive to any upside in precious metals.
The exploration alpha, extending asset duration. Beyond M&A, the company's ability to generate value through the drill bit is a core pillar of the bull case. The near doubling of the Wharf mine life to 12 years and the 75% increase in Palmarejo's inferred mineral resource base in 2024-2025 demonstrate a high hit rate for its brownfield exploration programs. At Palmarejo, the 2025 exploration campaign was the largest since 2012, focused on the East Palmarejo district. Crucially, this area lies outside the Franco-Nevada Gold Stream area of interest. Success in this district allows Coeur to retain 100% of the gold production value, rather than delivering a portion to a streaming partner, effectively increasing the effective margin of the Palmarejo complex as production shifts eastward.
Company Deep Dive. The 2025-2026 financial inflection, scale and deleveraging. To understand the 2026 outlook, one must first analyze the magnitude of the financial transformation achieved during the 2025 fiscal year. Coeur entered 2025 with a focus on capturing the benefits of its multi-year capital investment cycle, specifically the $364.6 million spent in 2023 on the Rochester expansion. By the conclusion of 2025, the organization had not only achieved record production, but had fundamentally re-engineered its balance sheet, moving from a position of heavy debt to a net cash status. Quantitative financial performance and efficiency ratios. The acceleration in 2025 financial metrics was driven by a combination of higher realized prices and increased throughput across the portfolio. Revenue rose 96% year-over-year, while adjusted EBITDA surged by over 200% to exceed $1 billion. This margin expansion is a critical second-order effect of the decoupling of operating costs from revenue growth. While revenue nearly doubled, costs applicable to sales rose by a comparatively modest 48%, much of which was attributed to the acquisition of Silvercrest and the associated purchase price accounting impact on inventory.
The company's 26% ROIC in 2025 is described by management as peer-leading, reflecting the high efficiency of the capital deployed during the Rochester and Las Chispas cycles. Deleveraging was equally aggressive, with total debt declining by 42% year-over-year. This reduction in debt service costs, combined with the release of a $216 million valuation allowance related to U.S. deferred tax assets in Q3 2025, provides a massive tailwind for 2026 earnings per share. The attainment of a net cash position, where cash, equivalents, and short-term investments of $553.6 million exceed total debt of $340.5 million, represents a fundamental shift in Coeur's strategic flexibility. Historically, the company was forced to navigate high interest rate environments with a more constrained balance sheet. In 2026, D680 allows for a massive 47% increase in the exploration budget to a range of $120 million to $136 million, and the ability to execute on its $75 million share repurchase program, which was previously restricted by the new gold transaction timelines.
Operational segment analysis. Rochester Mine, Nevada. Rochester is America's largest domestic source of refined silver. The 2024 expansion was the most significant capital project in Coeur's history, and 2025 was the first year of realization. Production volume. In 2025, gold production increased 54% and silver production increased 40% year-over-year. 2026 strategy. The focus is on reaching steady-state operations. The new 3-stage crushing circuit has improved availability, and placement rates are at all-time highs. Free cash flow. Rochester delivered $78 million in free cash flow in Q4 2025 alone, proving it can be a massive cash engine in a high-price environment. Palmarejo Complex, Mexico. Palmarejo has been in operation since 2009 and remains the company's most consistent silver-gold contributor. 2025 results. The mine produced $108 million in free cash flow in 2024. In 2025, it faced lower grades but compensated with higher throughput and the completion of the Hidalgo portal. Inferred growth. Palmarejo's gold inferred resources increased 97% to 1.3 million ounces in 2025, providing a clear path for mine life extension. Kensington and Wharf, Alaska and South Dakota. These two mines have evolved from mature assets into high-value contributors. Kensington successfully doubled its reserve-based mine life to 5 years. In 2025, gold production increased 11%, driven by higher mill throughput. Wharf. The Wharf mine is perhaps the best example of Coeur's organic growth strategy. By revising its technical models, the company nearly doubled the mine life to 12 years and increased gold reserves by 65% in 2025. Las Chispas, Mexico. Acquired from Silvercrest Metals in February 2025, Las Chispas is an underground silver-gold mine in Sonora. Financial impact. It generated $285.8 million in free cash flow in 2025, providing a substantial boost to consolidated margins. Asset quality. It produces high-purity silver doré with some of the lowest unit costs in the Coeur portfolio. Conclusion. The bull case is mathematically supported by the massive free cash flow generation, $666 million in 2025 and a projected $2 billion in 2026, and the undeniable scale provided by the new gold merger. Coeur has transformed its balance sheet, achieving a net cash position that allows it to self-fund its $130 million exploration program and return capital to shareholders. However, the bear case remains a vital counterpoint. The structural risk of Mexican jurisdictional changes, as exemplified by the Supreme Court's 2025 Amparo rulings, cannot be ignored.
Mexico remains a significant contributor to the company's tax burden and its overall production profile, and any further erosion of private property rights could severely impact the valuation of Palmarejo and Las Chispas. Additionally, the higher AISC compared to peers like Agnico Eagle means that Coeur remains highly sensitive to commodity price fluctuations. Coeur's unhedged exposure and peer-leading ROIC of 26% make it a compelling vehicle for aggressive growth. If, however, the market enters a consolidation phase or Mexican regulatory pressure leads to a permit denial at Las Chispas in late 2026, the company's high valuation and operating leverage could lead to a significant price correction.